All right, welcome everybody to the August 2024 Catalyst Funding Real Estate Market Update. We're excited to be back with you this month with all the latest information for real estate investors on the market across Texas and nationally. I want to introduce to you our panelists here today. We have from Catalyst Funding our founder and CEO, Wade Comeaux.
Hello, everyone.
And then we also have today with us our Director of Lending, Jeff Johnson.
Hello.
And then special guest with us this month, we always enjoy having Stephen Curtis from NRL Mortgage, their Chief Production Officer, is with us today.
Hey, Derek, thanks for having me.
Absolutely. So I'll turn it over to Wade to give us a little background on our relationship with NRL Mortgage and long friendship with Stephen Curtis, and then we'll dive into the presentation.
Yeah, thank you very much, Derek. Yeah, Stephen and I have known each other for 25-ish years now. A good friend of mine outside of work, as well as working together off and on for many years throughout that time frame. And I'm real excited about Stephen's new opportunity with NRL. He's in a much more significant position than he's had before. Great opportunity, fantastic company. Shortly after Stephen made the move there, we ended a partnership we have with another bank for our long-term loans and moved over with NRL. And it's been a fantastic process so far. But Stephen, tell us a little bit about what's going on with you personally with the move and with NRL in general.
Yeah, so thank you, Wade. I moved here in December of last year to take over as Chief Production Officer, which was the role previously held by our current Chief Executive Officer. So no pressure, big shoes to fill. But coming in here to focus on, incremental improvement and operational excellence. We bring a large team with us that does about $250 million current volume. In the COVID times, we're doing about $500 million. So bringing some of those improved processes and ideas, just bringing them to a company that's willing to accept them and enact change. Because at the end of the day, what we want to create a place that is the absolute best place for you to bring your business. We want you to feel like it's the safest place to do business with, that operationally we're always going to have your back and make it easy for you to close loans. And if we can close and sell or service the loan, we're going to do it. We don't abide to overlays or anything else like that. If Fannie or Freddie or Ginnie Mae will take it and we can sell it or service it, we're going to make the loan. And it's been a great partnership with Catalyst so far. Just to brag on you guys a little bit, you guys had your best month since you've been here, and it looks like the pipeline's growing even more. So I think it's been a great partnership, and I look forward to seeing what we have in the future.
Yeah. On a side note, I think we also are going to be close to or potentially breaking a record on our short-term hard money side as well. So a really exciting month overall. Great stuff. And I wanted to say a couple of things about the relationship with NRL. Well, I was also very happy with the group we were before. I'll just talk about the positives here. And they really are a couple of things that I really noticed. So if you're a loan officer out there that wants to be in the real estate investment lending space, or if you want to be in the traditional lending space where you're working with buyers of homes, which is what Stephen and his team really focus on, the big things I've noticed are a complete commitment to speed, like really passionate across the board. I'm talking processors, underwriters, closing. Everybody is really focused on delivering speed so that the transactions happen in a timely manner. Also, just real ease in getting answers for salespeople. Like if you want to have an answer on a complex situation, there's teams that are set up that are highly responsive, that are purely dedicated to that. You're not taking an underwriter off of a file to answer a complex question. There's a team dedicated to giving very timely responses to salespeople. Then also a real commitment to timely execution on marketing and just outstanding marketing, like really top level things to put you in a position to differentiate yourself in the competition with the marketing team there. That's just amazing to me. And then, one last thing I'll mention, the pricing. Pricing has been amazing. Like our salespeople really love it. Our clients love it. We were struggling for a while there to get some of the long-term refis done, and both in the DSCR and conventional space. We're consistently told that we have at the best or very close to the best pricing across the market. So it's really good.
Yeah, the pricing's great. The pricing is great. The one thing that the biggest difference that I've seen so far is, and relative to the folks that may be on this call, for the investors, is the DSCR speed of process.
Mm-hmm.
We would, we think we're very good at processing hard money loans. We can get those things closed in our sleep. And when it comes to DSCR loans, the refinances or somebody doing cash out, it was taking a little bit longer. But since the move to NRL, like those turn times have been like they've been reduced by weeks, not days. Like it's really been great working with the team over at NRL to do these DSCR loans. So if you're an investor, and we got a lot of new products coming out on the DSCR front as well. But if you're an investor and you do DSCR loans, if you haven't worked with us in the past, give us a shot because our DSCR, the pricing, but also the speed at which we can get these deals turned around is greatly improved. Very top.
Yeah, I would say, and one of the reasons for that is if you're a real estate investor and you're partnering with Catalyst and they're partnering with us on the takeout loans, we've got a commitment to where we actually can do some of these in-house. We're delegated underwriters. So we're not brokering them. The person that's underwriting them is down the hall from me. So if it's crazy, like I can just walk down there and say, what's going on? And then also our commitment to continue to search and bring on additional investors that make us the most competitive that we can, both in options for loans and price. As a matter of fact, we're onboarding one now. I'm sure maybe you've heard from Matt Kovach, but I'm not going to name the investor, but I'm very excited about the offerings and very excited about the pricing as well. So I think that's going to be a huge leverage piece for Catalyst.
I would agree with Stephen.
Very excited about that next week.
And we're delegated on that too. So we're going to be underwriting them ourselves, funding them ourselves, which is to Jeff's point, which is why sometimes we can do a DSCR loan in 21 days where other people's average processing time is 45.
That 20, we have closed them in 21 days, which is incredible. We can't guarantee that every time, but we have very, of course, cooperative borrowers who move quickly as well. But a big difference at the end of the process, if we are brokering these loans, as many of our competitors do, and we have in the past, that basically means at the end of the process, we get everything packaged up, and then it's often a 2 to 3 week process from there. Whereas with NRL, in the internal underwriting process through delegated authority, that's a 2 to 3 day process. Like that is just a total game changer. And to Stephen's point, he's down the hall. I'm 3 floors down. Me and Jeff are 3 floors down. Like it's such a difference just in the communication and the camaraderie that really the borrower can experience that as well, because it's far more efficient. Communication is just next level.
Yeah, we understand that when you're doing a takeout loan, an extra 3 weeks can be hundreds of dollars in interest. And that's a huge competitive advantage. So,
well, there's that. That's saving 3 weeks is a big deal. But a lot of times, whether it's our loans or other lenders' loans, there are sometimes extension fees or deferred origination fees that have benchmarks. And so if the rehab took a little too long or whatever happened and you're up against it, making those 2 weeks can be a couple $1,000s just in that fee alone. So it's a big deal.
Yep, for sure. A lot of great stuff in that particular category. So, let's dive into it. Really excited to have Stephen with us again and excited with the new relationship. I think most of you guys know we've given a good overview on Stephen. He told us about some exciting things on his team. So we're at the 10-minute point. So I say we dive right into Houston. And Stephen, I'm going to let you start with Houston here. I know this is your backyard and you know this area incredibly well. So tell us what you're seeing in the numbers and also what you're seeing personally in the Houston market.
Yeah, so we are definitely seeing inventory increase. We're seeing executed sales contracts steady, but when you look at the amount of inventory that's coming up, I think we have a lot of pent-up demand. I think I said this on the last time I was on, but there's an estimate that every 1% in interest rate reduction, there's 3 to 5 million additional people that qualify to buy a home. So this inventory comes at a good time. But on the back of tomorrow, we expect a friendly PCE inflation report, and that should be the nail in the coffin on not only just a cut, but probably a 50 basis point cut. The anticipation is 100 basis points between now and the end of the year, and the only way to get there is one of them has to be 50. Right. So I think some of it's priced in already, but we also have people that are holding back, waiting for that. My advice to the person that's holding back is get it under contract, because that price is going to be different when there's another 2 million people trying to find it. We don't even have 2 million homes for sale.
Yeah.
So if 2 million additional people are in the market, there's going to be upward price pressure. And we've been saying it for a while, but now we're really up against it. And I think we have an opportunity to, if you have homes that you can get listed out right now, or if you have projects that you're finishing, if you're flipping, I think you have an opportunity to get in before it gets super crazy, get it on the market. And then also on the holds, if you're starting deals right now that you're going to do holds for, we're hoping, we don't know, no one has a crystal ball, but we're hoping that we're going to see some decreased interest rates across the board soon, which is going to make everybody's numbers look even better. So definitely seeing higher inventory. If you look at it, obviously you can see year over year 30.5% increase in active listings. We're seeing that pretty much everywhere. But the thing that's interesting is the average sales price is still 5% higher. So even with an increase in inventory, we are still seeing the same appreciation. Houston has always been a safe haven market. We don't usually get hit as much as obviously the East or West Coast. We're very insulated. We have great industry. We have great job market. So even in times of economic turmoil, Houston has always been a very steady market. So I don't think we're going to see anything but more increase on average sales price. But I think what we will see is active listings go down as more people come into the market and rates come down.
Very true. And, if you look at the other three major markets, which we'll cover in a moment, Houston is the only one that is up as significantly as it is. Now, we always look at the pre-COVID numbers from July of 2019, and, we're not up as much as Dallas. But in the recent past, Houston is definitely the highest appreciation market out of all the major metros. And to your point, Stephen, there is some more inventory coming on board, but still, as far as months of inventory, we're certainly not in a bad position. 6 months is stable. Even pre-COVID, it was 4.4. Now we're at 4.3. Days on market was 50. Now we're at 44. So we're certainly not in a place where there's too much inventory by any means. And I think as rates come down, that inventory is going to be sopped up immediately. There's just so many people out there that are waiting to buy homes. And on another side note, we do hear this come from a lot of people, a lot of our clients. Stephen, I'm sure you hear it as well, and you kind of alluded to this earlier, but a lot of the price reductions that would come from this half point drop are in large part baked in. You should not anticipate that if the Fed drops a half a point, that rates are going to drop a half a point, because the markets have already baked in an estimation of approximately 50 anyway, maybe slightly less than that. So if it comes at 50, maybe you get a little bit of a drop, but it's not going to be 50 basis points. And that's a little bit of a misconception that some people might have.
Yeah, and it's also short-term rates, not long-term rates. So it takes a little longer to trickle into 30-year mortgage rates or even 10-year treasuries. However, what I will say is if we were to see September 16th through 18th, I believe is when they're going to have their next meeting. If they were to come out and say, hey, we're doing 50 basis points, we think it is baked in. We don't think the 50 is completely baked in. We think the 25 is all the way. We think the 50 is 75% baked in. So I'm telling people that the rates that you're looking at today, absent any crazy news between now and September 16th, 17th, we're probably only looking at a 20 to 30 basis point lift on mortgage-backed securities. Our steady state, it's been a pretty steady climb. I'm looking at some charts right now. It's been a pretty steady climb since May 30th. From May 30th to now, it's almost 400 basis points we've gained, and it's been pretty consistent. So again, a lot of that recovery is baked in. I think we're looking at maybe 25 to 35 basis points, maybe a stretch 40. But what does that mean, right? That means maybe a 0.25% better. It's not going to be the reckoning that everybody believes. So you might be better served to get your house now or sell your house now and attract buyers now, because it's probably going to be not as big of a deal as possible. Now they're projecting 125 basis points next year too. And if we get 225 over the next 18 months, I do think that for a single family new home purchase, I think we're probably looking at, low to mid fives. With people paying to maybe reach that high fours, that's going to take us a while to get there. And really, that's That's really our best case scenario, because if it went overnight, all this inventory would be gone.
Yeah, for sure.
Yeah, I saw. I was looking at the bet, not that not to be a DGen, but I saw on the betting markets, it's basically like 100% locked in that there's going to be a cut. Like you said, 25 basis points is almost like a guarantee, maybe 50 or not. As far as how what we just talked about would affect real estate investors, like to your point, with rates dropping, if I'm a flipper, I'm happy because that just means there's a lot more buyers that are going to come on the market looking for my product. If I'm a landlord, I don't know what you guys think, but I think it's a little mixed. I think if I'm a landlord and I haven't taken advantage of properties and I start buying now, I do think as rates go down, there's going to be more competition and the out of pocket is going to start creeping back up. It's not going to be what it was during COVID by any means, but it is going to start creeping back up. The good news is that with rates going down, and if you look a couple slides ahead, rents have gone up consistently. Your cash flow will increase. So it's almost like there's a balance to it where your cash out of pocket's going to go up because more people are going to be buying. But the good news is that there's more waiting for you at the end of the rainbow. There's more cash flow because you got lower payments and you're going to have increased rents because those have been going up consistently with all of this inaffordability. There's a lot of renters out there looking for single family.
Yeah, another thing that I would add to that, Jeff, is I invest in real estate. I'm not just on here talking about regular purchases, but I do invest in real estate. And I think looking at the market the way I do right now, if I had a little extra capital to grab a property in the next 2 weeks, I think there's an opportunity there because there's more inventory. Even though the rate thing won't happen immediately, if they do a 50 basis point, that's what the consumer sees. So the consumer sentiment is now I get active and buy. So I think you got a couple weeks to take advantage of this increase in inventory that we have in these markets and maybe snag a home in the next couple weeks that you could get probably your best deal in the next 6 months.
That's a great point because if you're smart and you pay attention, that cut's already built into the rate. But if it's not your world and you see Fed cuts rates, you immediately jump back in, even though it's not any better than it was the day before. That makes sense.
I think both if you're an owner occupant looking at properties to live in yourself, or if you're an investor, you're in a sweet spot right now. If you think about it, if you're an investor and rates do drop significantly, as Steve's talking about, investors are going to adjust their offers because the cash flows are greater. They're going to pay more for the properties because the cash flows are greater. Same thing for home buyers that are going to live there. My budget is I can afford $4,000 a month. I can afford $3,000. I can afford $5,000, whatever it is. And if the rates go down, they can pay more for that same property in the neighborhood in which they want to be. That's just the way reality works whenever rates come down. So you're in a really good sweet spot right now to whether you want to own a property to live in or you want to own an investment property. I think there's a window now when you can get some fantastic opportunities for sure.
Yeah, I would also say that, a product that we talked about last time that general consumers are using when they're listing their properties to try to combat the competition because the inventory has gone up so much is list and lock, right? Where we allow the seller, if you're the end seller, let's say you're doing a flip, and you want to make your house stand out amongst the rest of the inventory, through your partnership with Catalyst, they can actually help you get a list and lock where you can lock a below market interest rate for your incoming buyer. And we're seeing a lot of people take advantage of that because the inventory has increased. And instead of reducing home prices, they're reducing interest rates. Because when we go to the consumer and say, which would you rather buy, a $300,000 home at 6.5 or a $315,000 home at 5.5, they pick the 5.5 every time.
Yep, for sure.
Last thing I'll say on Houston till we move on. Of the major metros, Houston had the highest rent increase year over year in dollar figures. So Houston is very solid, like you said, very steady market. It's got the biggest price appreciation of any of the markets this month. So if you're buying in Houston, the cash flows are increasing better here than anywhere else.
On a side note, with 1% in rate reduction on our average deal, the borrower cash flows an extra $150. Steve just talked about a 2.25% reduction on the average deal. That might be, $250 or so, something like that, maybe more. So that is a profound difference. You think you go into the deal today and you're like, man, my out of pocket's fantastic, but my cash flow is just not great. It's 150, it's 100, sometimes it's 200. I'm getting great equity capture. But if the rates reduce and you do a refi, and refis aren't that expensive to do, you drop your rate 2%, that cash flow goes from 150 to maybe 450, right? Like that is a profound difference on your returns.
Yeah, you can lock in a ton of equity right now if you're willing to take less cash flow. The cash flow is going to come through general appreciation of rents and interest rates going down.
Yep.
Absolutely. All right, let's check out Dallas. So Dallas, as most people that have been attending the webinars know, is definitely the highest appreciation market in Dallas since in Texas since COVID. Sorry, look at that number. Since COVID, 63.7% and 52.2%. Just amazing numbers in a relatively brief period. We're talking 5 years. Just incredible. No, there's no other group or major metro that is that large. But if you look at it over the last year over year, it is slowing down a bit, which is a little bit what happened in Austin. Austin was it was the hottest appreciation market in the country for a while. Then it pulled back. Austin had a true reduction. We haven't seen a true reduction in Dallas, but we've seen a slowdown, kind of a flattening there, but still an amazing appreciation story over time. But you're seeing those months of inventory still not being as high as Houston was. Days on market, I think, also a shade lower. So the inventory story still seems pretty positive. I think Dallas has so many people moving into it and so many new white collar, high income jobs that I think it's going to be relatively steady. It did not have this crazy run up that Dallas did, but I'm sorry, that Austin did. But I think there may be a chance for a flattening for a while, because it maybe even a slight pullback, because it did have a huge run up over time. What are you guys seeing there?
Wade, what I find interesting with Dallas is Dallas Metro appreciation is higher than Houston. But when you get outside of Dallas Metro and you get to suburbs of Dallas, not directly, but the new ones where they're building now, it's actually more affordable than Houston. And I think that's why a lot of people are moving to that area. Jobs, obviously, but you can still get a brand new 4-bedroom, 3-bath house, brand new construction on that second layer of suburbia for under 400,000. And I see it all the time. And that's more affordable than Houston. So the market has multiple layers in it right now. And I think that's keeping that inventory number super small. I think the people that got in don't want to sell, because now the average sales price is $525. And I think people coming in are buying that new inventory so quickly at that affordable price point that it's really, really choking that market down to where you're just not seeing it. Days on market is 45 is really nothing. There's not 26,000 homes available for the Dallas metro area is nothing.
Yeah.
That's no inventory.
It's kind of funny where the epicenter of Houston, right? You remember Houston downtown kind of went to Galleria, and then so much of it moved further west, Energy Corridor, even out towards City Center. And a very similar thing happened there in Dallas. Downtown kind of moved up to Plano, and really a tremendous amount of Dallas's corporate headquarters are in that Plano, Frisco area, and even going further north. And then you also have just the incredible success story over in Fort Worth, further west as well. But to your point, there are so many outstanding jobs that are outside of the downtown areas of both Houston and Dallas that these tertiary markets that are a little bit further out, the new construction, you might only have a 30-minute commute to work, even though you're an hour and 15 minutes outside of downtown, right? Maybe even more.
Yeah, that's very encouraging what you said, Stephen, earlier about how the outer suburbs still have affordable housing, because that, like, if I see numbers like this, I start thinking, okay, is it going to start pricing itself out of being an investor's market? But if they have more affordable housing further out, and then if you look down at this chart here, the average lease price, it went in 5 years' time, it went from 1864 to 2623. So that is over $750 increase in rents over 5 years. So that is exactly what you were talking about in Houston a little while ago, where with just natural rent appreciation, you're going to get some lift in your cash flow. That's a massive lift. That's huge. I mean, that's like 125 a year, basically. That's to say nothing of reduced interest rates, right? That's just straight rent increases. So even though it's a hot market, I do think there's still good opportunities for buy and holders outside of the main area.
For sure. All right, let's check out San Antonio. Jeff, what do you see in San Antonio?
So San Antonio, it's a little down relative to Houston and San Antonio. Sorry, Houston and Dallas. Look at the average sales price is down 3%. The other two markets are up 5 and up 1. San Antonio's down 3. I think Austin's down almost 3. So the Central Texas area's got a little bit of a lull. Months of inventory creeping up 5.4. That's the highest in the state. So I will say this, and I keep reading articles about San Antonio. They talk about it all the time. They talk about how affordable it is as a big city, and they talk about how the economy is stable. You know, it's pretty diverse. It's got a heavy military background, which shouldn't change anytime soon. So, like, I see San Antonio challenges and the values, but I still think long term, it's a great market to buy properties if you want to buy and hold, because I do think there's just more upside in San Antonio than you would see just about anywhere else.
I do think they restrict themselves a little bit because they have a pretty tough permitting process.
100%.
And if they ever got any change at the government level when it comes to that, I think it could be probably the best opportunity in Texas.
Yeah, you look at the average sales price, you know, you've got Houston, 445, Dallas, 525, San Antonio, 376, significantly less. And then you've got Austin, median sales price, 450. They don't have an average there, so the median is always a good bit lower than the others. But and whenever we go over the affordability index later on, San Antonio average income is right in line with Houston, a little bit below a little bit below Austin and Dallas. So to Jeff's point and to Stephen's point as well, the upside for appreciation is really there because the people had the income to afford it. It just isn't as expensive relative to what they make. And then that also means that there's a lot of room to push up rents over time as well. Whenever you look at the average rent there in San Antonio, it's a good bit less than Houston at the moment, but a lot of upside in both those categories because you can always increase home prices and increase rents if people make enough money to afford it. And right now, it just happens to be significantly more affordable there in San Antonio. All right, Austin. One thing that I saw that was very interesting in Austin is that for the first time, the appreciation since pre-COVID in Houston is greater than Austin. So now from pre-COVID, if you look at it, median sales price is up 38.5%. Go back up to Houston, and median sales price is up 40% since pre-COVID. So the pullback in Austin has been significant enough where Houston has passed up home price appreciation since that point. Now, Jeff and I on previous webinars had covered that there are a lot of people out there that think that Austin and San Antonio are probably the two best markets to invest in, not only in Texas, but maybe in the country. And I do think that there's been an overcorrection there in Austin, that there's a real buying opportunity right now. So many of the things about Austin that are unique to any other city in the state are still there. And you got the tech boom there. You've got so many things going on. I think there's an overcorrection, and I do believe there's a real buying opportunity. And these national prognosticators consistently put out articles saying the same thing. So I thought that was an interesting number.
I think in Austin, and you guys correct me if you disagree, but it's almost to the point now where you might be able to start sneaking some single family rentals in Austin. The prices are dropping. And I don't know if it's on this report or not, but I was looking at an article that said Austin is the #1 rental market in the country. They look at like percentage of the people there that are renters. I think it has to do with job opportunities, etc. Like there are a lot of people in Austin that are renters but make good money. So you might be able to buy some properties in Austin as rentals. on the lower end of that scale.
I would also say that I think something that people forget about Austin is it's also home to 40 to 50,000 college students at a very affluent university and some smaller universities that cost even more. So I think there's some opportunity there if you can find maybe a multi-unit that needs some repairs. I think it's a great market to own a multi-unit in because it's always going to be rented. There's always going to be multiple applicants for that rental. And if you're willing to just be maybe 15 to 20 minutes away from campus, maybe closer to Round Rock, I think you can still get students in it. Now, Round Rock used to be a honey hole, and then they built Tesla right next to it. So it's getting a little harder to do, but there's a sweet spot in there where you might be able to get some value. So don't sleep on multi-units because there's a ton of college kids in Austin too.
Yeah, there's a lot more duplexes, triplexes, quadplexes in that greater Austin area for a lot of those reasons. Land is just so expensive and people try to put more units on a lot. One other thing to keep in mind, I think that to Jeff's point, why are there so many renters there? You think about it, well, there's a lot of big university there for one, but also whenever you are a young employee in tech, you don't want to get locked down into a home because like you may want to go work in San Francisco or another tech hub to get a big salary increase. You know, in tech, you never know, or you might want to go and work for a new startup or something like that. So in tech, people really like to be locationally flexible. So I think you're going to see a lot more people that will pay a very sporty rent rate, but they don't want to be locked into a home because if you do buy a home to live in, you really want to at least be there 3-4 years before the math works out. You know, you're paying some expenses and everything. So I think people want to be a little bit more flexible earlier in their tech career. So it makes a lot of sense that they're renting.
Another thing I would say, Wade, and this is maybe diving in a little bit too much, but when you look at tech companies like Tesla, they relocate a lot of people and they may offer as part of that incentive package to come some sort of rent incentive in their pay. And what a lot of people don't understand is when you're a large corporation, you'd rather give that than additional salary because whenever you go look at financials, one's a temporary cost and one's permanent cost when you have salaries. So you also have people that are going to rent because it's getting paid for. They have the flexibility of it and it benefits the corporation to do it that way. It's a very interesting market.
Yeah, for sure. Let's check out this article that Derek found. Very interesting. This is by Wallet Hub from August, so pretty recent information talking about the real estate markets. And what we found very interesting was how often Texas was on this list. This is basically covering some of the hottest markets in the entire United States. And they have a couple different ways in which this is measured. Jeff, I don't know if you remember some of the specifics there
I did.
Okay, yeah, go ahead and take that.
Yeah, so I mean, there's the things that they use. It's basically it's 80% real estate market, 20% economy. And the things that they looked at on the real estate market were price appreciation, mortgage delinquencies, days on market, vacancy rates, just how healthy is the real estate economy. There was a bunch of different factors, but those are the main ones that I looked at. It was and then jobs, right? So jobs are a big deal. It's 20% of it, but 80% was consistent price appreciation, serious mortgage delinquencies, days on markets, and vacancies. Those are the main things that I saw. You look at it, it's littered with North Texas, like you were talking about earlier, Steve.
Yeah, Steve
Well,
hit
yeah,
the nail on the head. All north of Dallas.
all north of Dallas. And that's where all this building is happening. And McKinney, and I can't remember the name of the town, but the one directly north of it now is where you're seeing the sub 400,000 brand new construction. But what's interesting is if you know the Dallas area, 6 of those 7 with the Texas on it to the left are basically Dallas.
Yeah.
Or the surrounding areas.
Is it Melissa,
the only
Texas?
one that breaks in, right?
Yeah.
And every one of those is north of downtown Dallas. But Carrollton's not exactly north, but you got McKinney, Frisco, Denton.
Carrollton, Allen, Denton, Frisco, McKinney, those are all north.
Yeah. And then you go through the next of the list, 29 Fort Worth, Irving. You know, that's not north, but still all Dallas. Plano is north, but it's a little more established, doesn't have as much upside, right? That's been there a little bit longer. But man, just littered. And then we've got Houston and San Antonio, which are still good markets, just down below Dallas. And then you still have Austin at number 12, which for a big city, pretty darn impressive, because Dallas, Houston, and San Antonio proper are definitely much farther down the list. Yeah, very interesting article.
I think you're talking about Melissa, Texas, Stephen. There's a Buc-ee's. And when you see a Buc-ee's, good things are about to happen.
Yeah, when they put one in Wharton, I said I should buy some acres because they're going to build a bunch of houses right here. But yeah, that's how it works.
Yeah.
Speaking about high-paying jobs, if you're near a Buc-ee's, I mean, relative to what may be going on in the middle of nowhere, that's a high-paying job.
For working in a gas station, those guys pay.
Yeah, no doubt. So this is let's see, is this the same article from? Well, this is a different. No, it's the same
by city size.
Yeah, that's right, by size. Okay.
Yeah. So Austin's number 3.
Yeah, on the large city.
Yeah. Austin's 3,
Fort
Dallas
Worth.
16. What do you got? Houston 23, San Antonio 39.
How about Amarillo making it into mid-sized cities?
Huh. Pretty impressive.
That's another town that it's still cheap. And if I could get a duplex anywhere near the university, I'd think about it. They're building a brand new veterinarian hospital. It's going to be the only the second one in the entire state of a state that is covered with agriculture.
Are you talking about Amarillo or Lubbock?
I'm talking about Lubbock, but I'm just saying it's adjacent. If you could go over there and find something that's coming in, and currently the only one is A&M, and if you don't get into A&M, the closest one is LSU. So this is the only other veterinary 4-year college that's going to be in the state of Texas. So you can get a duplex there. It might be a good pickup.
There's a ton of these towns in Texas that if you have the ability to manage these properties, there's opportunity. If we look at the affordability index at the end, they're littered with affordable cities in Texas.
I also think that, we've talked about college towns twice. I think college towns have the ability to help with management. And I'm sure that, there might be referrals that you guys have, people that are good at property management, but it doesn't have to be a chore to get a good buy and hold. It's always a good time to look.
For sure. Stephen, speaking of the veterinary schools, I have a feeling you may have a personal interest in that.
Yeah, my daughter is a senior at A&M.
Okay.
She'll be applying if that's still what she chooses to do at the end of this year. And that has been on her radar since she got to A&M, because if you can't get into A&M, usually you apply to LSU because that's the closest one. Because she's already at A&M and it's in-state tuition. But with that one coming online, if she had to do like a gap year where she worked, she would apply to be in that first class. So
yeah,
I might be looking at a duplex.
Yeah, it felt like you had a very strong knowledge of the veterinary school. Like, that's a little unusual. Like,
it was oddly specific.
It still had a real estate potential advantage to it. So I'm definitely looking at it.
Well, you might actually have to partially cheer for LSU whenever they play.
You mentioned, I was like, that ain't happening. Come on now, stay away from those guys.
I do a lot for my daughter. That'd be tough.
That's tough. All right. Let's check out this next net migration. We often look at this. This is one of the most current ones I've seen. And, if you're talking about investing in real estate, you're talking about supply and demand, which really drives prices. This migration trend has been outstanding. This is one of the more up-to-date reports that I saw. Out of the top 50 metros, Austin, number 1 in net migration. Really impressive. You got San Antonio down maybe around 15, DFW 16, Houston around 20. So the 4 major metros in the state of Texas really, really highly ranked in those top 50 metros for net migration. And that's always going to drive up prices. More people moving in, not able to build enough homes, and keeping those prices very steady. And if you're a landlord, people often rent for the first couple of years, even if they're very high income and they have a great job because they want to get a lay of the land. So just tons of great reasons to think real estate's going to do well in these 4 cities. Anything else you guys see there?
Well, if you dig into this chart a lot, we've talked about it a bunch, but if you look at the difference between the urban and suburban migration, San Antonio, Dallas, Fort Worth, and Houston, almost 90% of the migration is to the suburban areas.
Wow. That is incredible, huh? Austin's a little bit different. It's a little bit more.
A little weighted.
Yeah. That's a good catch, Steve.
Yeah, I didn't even look at the little dots. That's a great point. I was wondering, I was like, man, I've been reading a lot about these large cities, people are just getting out of there. And then I was like, oh, well, there they are. They're the little dots below zero.
Yep. It's a good catch. All right, so this multifamily construction report, what do you see in here, Steve? Anything jumping out?
Well, when affordability was toast, which it has been for the last 2 years, I think multifamily was big. And I think a lot of those projects are coming online. I think people are, when you see opportunity in interest rates, knowing how commercial interest rates work, if the Fed cuts it, your rate is better tomorrow if you're floating, right? So if I'm looking at it and I think that these rate cuts are coming, as Jeff said, it's almost guaranteed from a betting perspective. I might want to get ahead of it. I might want to get my ground broke. I might want to go ahead and get things in place, scratch some dirt, get site work done. I might want to be ahead of it to where I can get in and secure the locations for the developments that I want to do now, before money gets cheaper. So we're seeing it. We believe, especially in cities that affordability index is high, that we're going to continue to see a lot of multifamily construction, as opposed to what we've seen in the past. Now, obviously, 2024, that's what we were talking about. Affordability is off the charts. We build more multifamily so we can create affordability. I think we'll see a little bit of a dip, which is what this says. But I think it's gonna average back out, and it looks like this chart thinks that we're gonna get right on line with pretty much pre-COVID by 2027. So it's been going up and up as rates have been going up, and we've been seeing it. We talked about this maybe a year ago. I was on here, and at that time in 2023, I was like, if you can do it, this is where it's at right now. This is where we're seeing permits. This is where we're seeing the majority of construction happening. Now we're starting to see it soften a little bit, but I still think it's going to be a big part of the game.
Yeah. It's very interesting. Most real estate investors will often say, I really enjoy my single family. I'd like to get involved in some commercial multifamily at some point. It's good to have diversification. But one thing that's been interesting in this time of rapidly increasing rates and increased costs in other areas like taxes and especially insurance is that if you invest in single family real estate, rates, what we've seen currently is that while rates impact your cash flow, if you don't already own the property, if you're stabilized and you're in a 30-year mortgage, right, you're in pretty darn good shape. Like if you had that 4.25, you did that 4% loan, and home prices have not dropped. Conversely, if you're in some type of bridge financing for a commercial loan or a multifamily loan and you're trying to come out on the backside, there have been a lot of very savvy investors who are getting crushed. And even some people who had stabilized properties who were going on floating rates have really been crushed because that net operating income, it's a different appraisal. If you haven't really studied this, it's a different appraisal for commercial multifamily properties. It's not just based on comparable sales. It's based on the income, the cash flow, and the expenses. And if your expenses go way up because rates have gone up, insurance has gone up, the value of your property goes way down. That's one of the great things about those properties in a more stabilized market. You can add value without the other properties selling around you going up in value. You can do it by decreasing cost or increasing rents. But some things are also out of your control. And I think no matter what, even for the most wealthy people, having single family in there and the stability that comes from owner occupants keeping prices up is a really big factor in that single family real estate investing.
Yeah, I would agree. If you see empty shells for commercial real estate, which they're all over the city, the reason those exist is you start construction at a 4.5% rate, and then the Fed starts raising them. You finish it at a 9.5. You had a cap rate of 8. Now you have a cap rate of 4. And so you have letters of intent for people to occupy at $23 to $25 a square foot a year. And you've got to go back to them and say, I need 38. And then they just say no. So you have no renters and you have an empty building at a 9.5% rate. And the bank probably doesn't want it back. So they're just going to stick you with it, and you just got sunk cost. And the only thing you can do is wait for rates to come back. Where, to Wade's point, adversely, if you would have bought a single family residence at 7%. If it still cash flows, it still cash flows. You're unimpacted by what's going to happen. As a matter of fact, the only thing that can happen for you is additional equity, which you probably got more upfront because rates were high, right? And then when the rates come back down, you can refinance and you can get more cash flow.
Absolutely. This next slide, Jeff, do you want to speak to this one? Just showing the home price appreciation since 2020-ish, maybe a little bit.
Sure. I mean, it's just we talk about it a lot, but it's just a nice chart to show, like, the value of investing in single family properties. The average price of a single family dwelling in the U.S. has gone up 7.5% since January. Single family homes have increased 43% over the past 4 years. I mean, you can look at this timeline. You can go back further. You can pick whatever you want, and with very few exceptions, purchasing single family homes is a pretty consistent, steady increase in your equity and your wealth. It is what it is. It's not like you said, you don't have the risk of the floating rates. The only real risk you have is taxes and insurance going up, which happens, but it doesn't beat rent prices.
Yeah, if this were a chart on commercial and multifamily prices, it would not look like this.
Would love to see that chart.
It'd be just the opposite. Just
going exact opposite.
Yeah. All right. This next slide is interesting. Now, this is not talking about home price appreciation. This is talking about equity growth, right? Up 9.6% year over year and up 1.5 trillion. And one of the things that we really like to help our investors with is, if you own a property, if you've owned it for the last 4 years and you think, I don't know if I have enough money to invest in real estate. You do, because your home's probably gone up 40, 50%. And maybe in other parts of the country, even more. And that's what a lot of people are doing. You might say, hey, 6% rate right now, 6.5% rate is not the same rate that I have on my current mortgage, right? You might be at a lower rate. But if you increase your mortgage payment a couple $100 a month, but you can get 4, 5, 6 cash flowing properties that are going to make exponentially more than a couple $100 your payment goes up, that is a absolute no-brainer. And debt equity, if you talk to any real estate investment guru, debt equity is one of the worst things you can have. You might as well put that money to work and have multiple properties. At the end of the rainbow, if you have 5 properties worth, 2 million, maybe 3 million, that's way better than just having one property that's free and clear. It sounds nice to say it's free and clear, but it might only be worth 500,000 at the end of the rainbow. Totally different scenario. Anything to add here, gentlemen?
Nope.
So Steve, you speak to interest rates incredibly well. You covered this a little bit, but is there anything else on this next chart? If we can go to the next slide, please. Thank you. Tell us your interpretation of this chart and anything else that you didn't cover previously on rates and where you see them going.
Yeah, I think when you look at this chart, you can see that obviously in October, we got pretty close to the highest, and then we almost revisited it in April. We had a steep drop from October to January. As a matter of fact, we were getting really close on some government loan options to being under 6% around December 28th. We are very close to that same level on the treasuries right now. So that's very good. And for your investors, I mean, being in that 6s and having options to do buy downs or whatever you just decide to do for cash flow is great. And that means everything's coming down. DSCRs are coming down, everything's coming down. And what we think this chart will continue to do is, I've always said that the recovery will be like this. It wasn't just going to be this way. So you got to pick and choose your spots. It's going to continue to go down. But I don't think it's going to be just cut it. It's not going to be like COVID. We're not having a nationwide pandemic. We're having an economic recovery. And I know a lot of people say, how can you be in a recovery when the economy is so strong? Well, it's really not. We overstated the jobs by almost 1 million.
Saw that.
And if those would have been accurate numbers throughout the year, we probably would have lower interest rates than we have now. The dual mandate for the Fed is lower inflation, and protect the job market. And if those numbers had been missing along the way between December and now, it's likely that we would have already had our first rate cut. So all that to say, we're in a great position for them to continue to come down, but I think it's going to be slow. And I think it's going to be more consistent than it has been since October of last year. I think you're going to see eighths to a quarters at a time. I don't think you're going to, what's really good is you're not going to get locked into a loan today and regret it next week, right? You might lose an eighth, but that eighth you probably picked up in equity because you didn't overpay for the property. So it's going to be fine. But if you consistently invest and you consistently pick up properties, you're going to have to start paying a little bit more, right? You're gonna get a little less equity, but a little bit more cash flow. It's just gonna go like that. Right now you're getting equity, cash flow might be tight. We're just gonna watch it slowly get here. Okay, that's what you're gonna look for. But all the ones that you lock up right now, you're gonna really win on.
So I was looking at this chart. It's a week old, and today's it's actually 11 bips lower than this. So they come down a little further. And to your point earlier about the jobs reports, I'd be really curious to see what rates do when the corrections come out, because they're always significant and they're always worse than what it really is. And so I'd be really curious to see if rates, when that happens, if rates start trickling down on those days when the correction comes out, that we was actually 500,000 jobs worse than initially reported. You know what I mean?
Yeah, unfortunately, we do not respond to corrections as much as we do the initial news.
Yeah.
We knee jerk on the initial news and we kind of scoff at corrections. So even the 818,000, we got about an 18 to 28 basis point lift, depending on what treasury you're trading on. You would think that would be bigger news. It's almost a million jobs. Again, we scoff at corrections. What people don't know is when the BLS does job reports, a lot of it is based on a specific birthing rate. So they automatically just assume that many more people went to work. And then when they go back and do the numbers, they have to make a correction. So it's always going to be wrong.
Kind of crazy. Especially in a world today where we have so much data at our fingertips. It's a little surprising that we can't get a little bit more accurate data from that.
I mean, every single company that runs payroll has to also pay
IRS
tax on it. So you would think they could get it.
Yeah. So this is an interesting chart. Stephen, you talked about how the interplay between the 10-year treasury and mortgage rates. Talk to us a little bit about what you see on this chart.
Yeah, so in stabilized markets, the relationship is about 1.5, 1.5. And right now, if you look at the 10-year, let's just look right this second. I think it's probably 3.8. So if you did 1.5, we'd be at 5.3. We're not there right now. We have a bigger spread. Part of the reason we have to have a bigger spread between mortgage-backed securities and the treasury is no one believes they're going to get the return on the mortgage-backed securities long term because these rates are going to fall, right? So we have to pay them a higher spread to take these loans, okay? Because they're putting up money that they don't think they're going to get the full return that they would if we were in a stabilized market at a 5% rate. So if the 10-year, in a normal circumstance, if the 10-year was just to return to 3, okay, 3%, and we got to a 1.5% correlation, which is historically where it is, rates would be 4.5. So the 10-year is not that far from where it needs to be. What we need is a stabilization in the economy and inflation and the Fed rate so that we can get the correlation between the two rates back to its normal relationship. So it's a two-part thing. First thing is the rate cuts come. The short money gets different. They don't need as much. Now they feel like we're stabilized. So now we can bring that spread down. When the Fed rate changes and goes down, you're going to have more people being willing to buy the mortgage-backed securities because they're going to be looking to other places to make gains. And with more, obviously, competition, you don't have to pay as high a yield. So when we get to that point, the correlation will return. And that's really where you're going to see those rates kind of settle. So I'm looking forward to it. We're getting there. Next month should be the very beginning. But by the end of the year, we should see this chart start to squeeze down maybe 75 basis points closer to what its normal correlation is.
Yeah, be a welcome change for everybody. For
Yeah.
sure. I'm going to suggest, because we're at 12:56, and that was an amazing breakdown on interest rates, Steve. Think that was for our people that are on the webinars regularly. I'm sure they got a lot of great info there. But let's go to page 21, if it's okay. We're going to skip a few pages because I really wanted to go over this. I think this is a great chart. Top 10 rental markets. We talked about this earlier. There's a lot of success stories in Houston and Dallas based on the current numbers, but sometimes whenever people are in a state of retraction, like a little bit Austin and San Antonio are, so those are the best markets to invest in. Jeff hit it earlier. Austin number 1, San Antonio number 4 in the entire country in rental markets. Jeff, what do you see there?
No, like I said earlier, I think with the San Antonio market being down as far as price goes relative to the rest of the state, and Steve mentioned the strike force, that might be one of the reasons why. And the fact that it's the number 4 rental market in the country, that just leads me to believe that buying rental property in San Antonio, as long as you get your orders and your permits right, is a good buy. Like there's just a lot of room for growth. If you look at the average rent cost in San Antonio versus say Houston, forget Dallas for a second, but just look at the cost of a lease in the two cities. It's just significantly less, I believe, in San Antonio than Houston. And I don't see any reason why it wouldn't eventually start creeping back up and being steady. It's a good economy. It's a good market. It's very stable. Texas is growing. It seems like San Antonio would be the market would benefit the most.
Yeah. And we've talked a lot about the strike force there in San Antonio. I do want to make one point. If you simply go and open the permits, it's really not that big of a deal. They're vindictive if you don't do it at the beginning, for sure. They make your life very, very difficult. If you try to slide one past the goalie, not a good idea. Go get the permits. And we have investors who are doing very, very well there because there is some trepidation from other investors. But if you're willing to just go and pay for the permits, get them to come out and rubber stamp the work you're going to do and check it at the end, which actually is not a horrible thing, right? You're not paying contractors for work that's not properly completed. There is some advantages to that. Don't get me wrong, it's an added expense, but I do think the pricing there in San Antonio is very attractive because some people are stepping away from the market and all you got to do is keep them involved. So we have a lot of investors who are really doing well in San Antonio. The ones who are not doing well are the ones who just try to not have the permitting process involved. And you make a big mistake if you try to do that.
Yep.
All right, next slide, and then we're going to just cover this one, and then the affordability index real quick. We're almost through. I'll cover this real quickly because this chart is interesting. Now, keep in mind, this is not a chart that says that single-family rents are dropping. This is a chart that says the rate of increase has dropped, right? The rate of increase got really high for a while there. This single-family rent index year-over-year percentage change. So we had massive increases, 14, 16% range for a bit there. It's really come down, but it's starting to go back up. So that is an interesting chart. You see whenever rents dropped last time back in 2009 and 2010. Last thing I wanted to cover, just the affordability index. We'll go very quickly and then we'll open it up to questions and our winner for today. But if you look at this chart over time, Dallas is creeping back up a bit. And this is a lack of affordability index, right? Dallas is number 17, Austin 25, Houston 32. But the really interesting thing is San Antonio way down there at 73. And you look at the household income, 62,000. Houston 62,000. Right? Identical income, but the homes are exponentially more affordable. So that chart that we just saw a few minutes ago, I do think we have some people in San Antonio that are like, is it still a really good time to invest there? That chart tells me absolutely is a great time to invest there. Anything else jumping out to you guys?
Steven, I don't know if you look at number 77, Steven.
Lubbock, baby.
I was like, look at 70. I was like, I guarantee you, Steven saw 70. He's like, sold. Let's go.
I already saw it. 62.
Where's Amarillo?
Same income as Houston.
Wow.
Cheaper
I
to
don't
buy.
see Amarillo on there at all, but Lubbock is just like flashing red lights for Steven.
You heard it here first, folks. Love it.
The fifth major metro in Texas. All right. Derek, if you'll join us, I don't know if we have any questions today. We have time for it, or if you just want to announce our winner. But
we've got one question and we've got a winner. Yeah. So the question is related to the single family versus small multifamily. We've talked a lot about the college campuses and the potential for small multifamily. Someone asked, what are the key factors to evaluate when assessing potential ROI with single family versus small multifamily, such as rental income potential, expenses, etc.?
Well, I think they're just a very different evaluation. Everything from the appraisal to your income expectations are going to be very different. That's a pretty complex question. I don't know we can cover it now. But the key thing, as far as the value, how the value is determined, it's important that you understand that on that appraisal, we're going to do a subject to repairs appraisal, and it's going to compare to other owner-occupied homes. That keeps the value stable. Conversely, an appraisal for a 2 to 4 unit, 8 unit, 50 unit is not based on comparable sales purely. It's based on comparable rents in the area, expenses, et cetera. Then a net operating income calculation is created to determine that value. So it's just an entirely different process.
Great. And we have a winner on today's drawing, half off your next hard money processing fee. Cedric Wilson, congratulations on winning today's drawing. You have to be live to win. So definitely join us next time on the Real Estate Market Update. Guys, thanks for being with us today and providing all that great knowledge.
Yes, Cedric is a multi-time borrower.
I think Cedric just closed the deal. Should have won last week. We'll save some money.
Just a little bit late. He's got to come back and do another one.
Cedric, go to Lubbock.
All right. Stephen, as always, thank you, man. Really appreciate it.
Yeah, of course. Had a great time.
All right. Thank you, guys.
Thanks, Stephen.
Bye-bye.